Hi, and welcome to the Build and Exit podcast. I'm Julie Wilkinson. I started the podcast off the back of the work we do in our company, Wilkinson Accounting Solutions, where we help business owners and investors look to maximise wealth on exit, which also often includes a buy and build strategy for acquisitions. So I'm lucky today to have Taha with me. Hi, Taha.
Hello.
I've known Taha quite a while. He's actually a client of Wilkinson Accounting Solutions. And the reason I got Taha on the podcast, so a bit of background, Taha was in a family-run business for about 15 years. And one of the things we're going to talk about today is diversification in investment portfolios. And Taha realised there was a bit of a risk of wanting to diversify, so has successfully gone out and started Lifeboat Capital and has now acquired businesses and has managed to introduce that diversification. So I think there's going to be a real interesting story here, especially from sort of planning stage to now someone who's actually doing it, which is great. So first of all, Taha, I just want to hand over to you and thank you for coming on the show and see why you wanted to come on the podcast.
Well, perfect. Thank you very much for the invitation. I just thought it'd be nice to share some of my some things I've been learning over the last 4 or 5 years with your listeners. So yeah, very very delighted to be here.
Yeah, brilliant. So let's take it all the way back then. So I know you were in a family-run business for a long time, and then you there was a point in time, which I can't remember which exact year it was, but you started to think there was some risk perhaps and you needed to diversify. So take us back. What made you get into the family business and realise you needed to do that diversification?
Yeah, perfect. Yeah, so thankfully we have a very successful family tea business, which has been going on since the 80s. It's one of the largest tea companies in the world. So it's a brilliant company. But in 2019, my uncle suggested I go on a family business course at the IMD in Lausanne, near Geneva. And it was just a week by a lake in Switzerland. So what could go wrong? So I signed up, and in that course, I was sat next to about 40 different family members across, very large businesses, some spanning over 300 years, worth billions. And the key theme that kept on reoccurring with all these families and that they were teaching on the course was the idea around diversification. So the point was that families that have successfully managed to maintain wealth across generations have done so through diversification. So they might make their money in tea or coffee or coal mining, but the really smart ones, when they had the cash available, they set it aside and invested in other assets, so either real estate or other businesses, so that if anything went wrong with their legacy business, there would be another pool of capital to support the family across generations. And so this was a bit of an epiphany for me, because having been working in the tea business for about 10 years, I could see, that it was, like any business, it wasn't perfect and there were risks. And it just made a lot of sense to start thinking hard about other areas of investment. And so I came back with this big idea. And so I basically said to all the family members, we need to create a family fund. We need to start putting capital in other businesses. And I started talking to wealth managers and other investors about how to get this done, effectively trying to set up a family office for us for the first time. And it was an interesting journey, because two things happened. Firstly, I started learning a lot about investment, and I started becoming very, very interested on a personal and intellectual level on the subject of investment. And then on the other hand, I started learning that it was very hard to develop a collective mandate when you have 10 different shareholders with different ages and different risk appetites. And in the end, what happened was, one of my uncles was very sort of specific that he only wanted to invest in real estate. So either we put money back in tea or real estate. And so he was out. And our chairman at the time wanted to only go ahead with things where there was consensus. So it was slightly frustrating, but I turned around and I said, look, just lend me some money. I'll invest in other areas. I'll report back in a year, and I'll let you know how it goes. So I was very lucky that they gave me a little bit of seed capital to start my investment journey. And thankfully, the first year went very, very well. So I had a 115% return in the first year. The second year was another 15%. So I kind of went back asking for more funds. And until we got to about 2022, which, if you recall, was actually the worst year in the stock market since 1871. The general market came down by about 20%. And I was in my prime, doing all the right things, but I could see the value of my portfolio just vanishing in front of my eyes, and it wasn't a good feeling. And I was kind of running out of patience. And at the same time, whilst I'd been learning a lot about investment, I'd been thinking very hard about buying a private business. So up until then, I had been investing in the stock market effectively, buying very small shares of successful businesses or other funds, but been reading around the edges around how to buy a business. And so that search for how to buy a business and for the right business really accelerated in 2022, when the markets were coming down, and I was looking for a way to invest where I was more the master of my own destiny, where I could actually impact the outcome of the investment through my work and my own efforts. So I was, as I said, reading a lot about investing, about Warren Buffett. The same time, I started working closely with a friend that I met on an MBA program, and we started researching where to find companies and how to buy them. And very, very pleased to say that we bought our first company towards the end of June in last year, 2023, and it was a small printing company in Essex, which turns over about £3 to £4 million, has an EBITDA of about £800,000. And it's a very special company, because this was the print company that was responsible for all the fulfillment of all the COVID in-home test kits. So I don't know if you remember, but when COVID broke out, we all got these COVID test kits delivered to our house so we could test at home, and they did the fulfillment of all of that project. So very well trusted company, and the owner had made a killing with that one project, so he wanted to sell his company, and because it was a print company, not many people wanted to buy it. So we were quite keen to talk to him, because the print sector, even though it's in decline, is still worth about £7 billion in the UK. So we got on well and put in an offer and finally accepted. And it was a really, really, really fun journey. Just that whole process from deal origination to due diligence and getting over the line, and then also following up and securing a management succession was all really, really fun. And we bought another company earlier on this year, and we're moving on to our third, probably in the next 12 to 18 months. So yeah, that's really my story in a nutshell. And happy to take any questions.
Yeah, no, that's really good. So if you go back to the acquisition, so obviously you've done these sort of smaller stakes, you decide to buy your own business effectively. So how did you go on that journey? So how did you find the business, the first business that you bought?
We tried all sorts of different things. We tried off-market deals, so reaching out to people on LinkedIn, going through various databases online, et cetera, et cetera. And we also tried going through brokers, and thankfully, well, in the end, we had a bit more luck with going through a broker. And so yeah, it was through one of the main brokers that we came across it. But we looked at about 200 different investment memorandums, and met about 30 different companies, put about 20 different offers in, had about 10 different site visits before we actually settled on this deal. And those are the sorts of numbers that we're going through in our following transaction, because our philosophy is very much geared around finding the right business, rather than trying to fix any business to make it what you want it. So we spend most of our time researching the right types of companies, and then finding the right managers to run them. So yeah.
So just say those statistics again, because it was quite quick. What did you say they were? You had how
Well,
many deals?
Yeah, so we looked at about 200 different investment memorandums, so about 200 different companies for sale. We probably met around 30 different companies, We probably put in about 20 different offers and then had about 10 different site visits before coming to our first deal. And you
Okay.
can almost double that, as in that, and that was the same kind of ratios for the next deal, and it'll be the same ratios for the one after that probably as well. So we go through a lot of deals basically.
Yeah. So then so the one that got accepted, what do you think made that offer get accepted over some of the others?
I think we had quite a motivated buyer. He had made a very decent amount of money from during COVID, and he just wanted to retire. So he wasn't, waiting around. Didn't want to wait around for 20 years for the right price. So that was one point. Because it was a print company, the valuation wasn't the same sort of multiple that you would pay for, let's say, like a mature IT company like a Google or something, because it's kind of not very popular, and a lot of print companies are going into liquidation, literally every other month. So not many people were interested in that. So it was kind of a good deal. So I think it was two things: a motivated buyer and a decent valuation, because it was an unsexy sector.
Yeah. And how have you found the sector since you acquired it? I mean, have you seen it positive change? What are you doing now? Are you diversifying that business or?
So our objective is very much to maintain the business at the current levels rather than to double revenue. Because if we wanted to double revenue, it's very hard to do it without further investment. But we'll make a fairly decent return on investment by just maintaining that level of profitability and sales. So for year one, our game plan has been objective has been business continuity. Year two, it's going to be probably sort of about 15% growth in top and bottom line, and we're planning on achieving that mostly through much of the same as what they've done before. So, where they talk new business development in the niches that they have a competitive edge. And our vision is to make that company into the UK's leading technology and customer focused print marketing company. So we're quite keen that the vision is embedded in the business, so that they know where we're trying to push this. Our vision isn't supposed to be be the quickest print company to go bust. It's very much the opposite. So
Yeah. Oh, wow. Yeah, no, that sounds great. So you did this company, you've got it, and then you acquired, what was the second company you acquired?
So we acquired another relatively small textile business in Oldham, north of Manchester, and that was very much a love at first sight situation. Family wanted to retire. They had a very interesting niche, decent margins, unloved sector. No one likes. I mean, like printing, textiles has had a big struggle in the UK over the last 100 years, or even 50 years. So, but yeah, again, motivated seller, um, and, uh, and for that one, we actually put in a new CEO from outside. So the first one we promoted somebody internally, and the second one we actually hired in a new MD, and I think most of our learning in the first year in the last 12 months has been around how to find the right MD, because it's very, very hard to judge someone's character and suitability over just a couple of hours of interviews. I mean, you really have to see them in practice, but it's sort of too late, in that sense. But so we've done a lot of work recently in gaming up on our recruitment process and criteria for new hires. So, but that's been also interesting. Fighting a general decline in trend, particularly with Brexit and the impact that's had on its European business. But we have a very solid MD who's got a strong accounting and sales background. So, fingers crossed, he will deliver on our objectives. And so far so good. It's been been interesting. It's early days though. It's only been a few months.
Yeah. And so you obviously got this CEO in. So then interestingly, so I'm interested to know, how are you funding these then? So this MD that you've acquired. So where has the cash flow come from? To because I suppose were they being paid before, or is this like a new budget that you had to bring in an MD?
So with the MD, there was. So with the textiles company, there was a father who had had a son and a daughter, had two children, and the brother and sister, they both wanted to retire at the same time. So whilst the brother and sister want to retire, the new MD comes in, and there is an overlap, which is probably going to last 3 to 6 months, where they're all going to be in the building, which is quite expensive. But soon those guys are going to retire, and the MD will take over their role. So yeah, we have to stomach both their costs for a few months, but they're reducing their hours, and so the company's just afforded it through its existing EBITDA, effectively, its existing profits.
Yeah,
So,
no, definitely. Oh, yeah, no, brilliant. It answers the question, because I think a lot of people are they're buying these businesses, and like you said earlier, they just want to grow. I mean, I believe we've seen it in our business. I mean, we did an asset sale, and it probably took us 12 months to stabilize, because we did quite a difficult bit of a turnaround for our own business model. But you do sometimes have to stomach extra costs, and this is one of my things with these no money down deals that are always being taught. Is this is the problem? Is people don't then have the money to then end up bringing the person in that they need, or the support they need, whether that be finance teams or MDs, whatever they need. They haven't got the money to do it.
yeah, absolutely. So you end up kind of putting your own time into the deal to sort of stimulate things. I mean, I think it's a challenge. Like, all these deals are a challenge. Even the most straightforward ones, when you've got to get a really well qualified MD in place on an already good business, it's there are a lot of hurdles to overcome, but it's kind of interesting and fun, and it's very nice, because you kind of learn a lot as you go along about different people, about different industries. So, but it's not easy. Like, it's not straightforward as some people make it sound. But I think it is it's a challenge that I've enjoyed
Yeah.
I've enjoyed so far. Yeah.
Yeah, and I suppose in time aspects, I mean, is your time sort of full time on this investment company to allow you sort of the brain space and the time to sort of do these, bring in these strategies, or are you working somewhere else as well?
No, so yeah, I basically work full time now for Lifeboat Capital. I still am involved in our family business, mostly at a sort of a board level, but most of my time is focused on Lifeboat Capital, and its portfolio companies, but also its other investments. I mean, we still have a fair amount in public companies, and but there's a lot to do. The risk is, you don't want to undermine your MD by getting too involved in their day-to-day business. You don't want them to have to come to you every 5 minutes, because you're kind of really micromanaging them. So you have to strike a balance where you trust them and give them space, but at the same time, you need to kind of set up a framework around their performance, so that you can easily monitor them to make sure they're going in the right direction. And so yeah, we're just sort of finding our feet and our balance with getting that routine set up for reporting, so that we can spend more time on other deals, on our deal flow pipeline, and thinking about the next deal.
Yeah, and this is why I wanted you to come on, Taha, because I think your situation, it's not fully unique, but I think the biggest problem in acquisitions is what you've kind of done is you've slowed down, acquired, and brought the right people in. The problem with a lot of acquisitions, if you've got current business owners that are already firefighting, that are then going to buy businesses with little capital or trying to get it from itself. So they might acquire it, but then once they've acquired it, they don't have the money to bring the MD in. So then what happens is the buyer, who's the business owner, is now firefighting two businesses, because they're now trying to run them both, and they don't have the capital immediately to bring in the resource to help them run the business. That tends to be when we see typical acquisitions. So that's why one of our focuses when when I do my keynotes with Wilkinsons is we're trying to get people to really stabilize their current business first, stabilize their current business and put the right processes in place. Because when you come to, if you haven't got your processes in place in the first business, when you buy the second one, they don't have processes in place. Where do you find the time and money to do it?
Yeah, no, absolutely. I can see how that can be very, very complicated because focusing on one business is hard enough if you're an operator. I mean, I think the difference between those people and myself is that I consider myself an investor, whereas those guys are operators that are seeking growth through acquisition. So I'm very, very mindful not to get dragged into operational matters and try to sort of have a lot of red lines where that's the MD's responsibility, so that I can stay focused as an investor, because they are two very different hats.
Yeah, I agree, and I think in reality the operators in the business, I suppose, if they're going on the acquisitions, that's why we're trying to influence it early for them to move to the silent investor, because just because someone's an operator in their business doesn't mean they always have to be. The problem is they need to transition their role. Yeah. Because to be not an operator in their own business and become the investor mindset. Because once they become the investor mindset, then they're free to do the acquisitions. The problem is when they're trying to do them when they're still the operator, I think is the biggest problem, because they don't have enough time, and often they haven't got enough money, or they haven't got the right mindset. They feel they haven't got enough money. Perhaps they could have enough money if they did some cash flow deep dives and analysis, but they might, if they haven't recruited in their own business, you'd beg the question, why haven't you invested in your business first before you're trying to invest in another business?
Yeah. And it's very, very hard to move from being an operator to an investor. If you're talking about your own business, if you found it, especially. I mean, I see it in our tea business, founded by three brothers and a cousin, and now they're in their 60s and 70s, and they're finding it very hard to let go of the day-to-day and to act as owners at a sort of a board level, because it does require a change in how you approach problem solving, and it's not easy, particularly if you've spent 20-30 years and whatever you've been spending the last 20-30 years doing has been successful and it's created a very successful business. It's hard to move into another way of working on your same business. And a lot of people don't ever get there. But yeah, you can't really go around acquiring other business if you, well, you can, but it's hard. It's harder if you really want to get involved in the day-to-day of numerous businesses. You're going to burn yourself out. It's not easy, but lots of people do that, and they are very successful. It's just not the model that I've chosen to take.
Yeah, no, it's a good model. And I think it's good for people to hear it, because there's a lot of people, I think people can transition. I mean, I'm probably going through that journey myself. I mean, I've done it a little bit differently. So, when I launched Wilkinsons, the first couple of years, I did more just consultancy to test the market, to see what I think people wanted. So it was kind of just me for a couple of years. Then when I brought the group CFO on, who you know very well, don't you, Taha, Tilly, he came on board, and we made the decision that we were going to go into acquisitions. We made the decision that to do that and the exit planning, we needed to have more overall services, because we needed to be able to, because obviously we've got the skill set, we needed to be able to help people put good infrastructures in place, do the tax, do the due diligence. And the way we decided to do that was to acquire. So we were probably a bit different. Like, we hadn't grown to a multi-million business when we did the acquisition. We did our acquisition purely to bring in the clients, to, I suppose, in a way, it forced our hand to put the infrastructure in place to get the services. And we have done that. But then if we are going to do some more acquisitions, but then we're transition, I don't work full time in the business. We've managed to do that. I've managed to do that with bringing the acquisition on, because I've done it as I've gone along. It's not perfect. I'd probably say I work about, probably about 50-50 at the minute, in and out. But, we know now that if we do the next acquisition, it can't really be us because we know we haven't got the capacity as a people to do another. So the next one we do will be a different setup. We will be more like you. It will be more of an investor bring in, where we don't sort of manage those clients and do it. We sort of run the portfolio. That's the idea anyway. So that's kind of what we did when we did our acquisition. So we did it slightly differently because we probably did it at an earlier stage. But we were capable of doing that because obviously with what we do for other people, with all the acquisitions we work on, like we knew how to do it.
Yeah, and that's really interesting because it goes to the point that we are constantly evolving as well, and we're learning a lot as we go along. And who knows, maybe in a couple of years we'll be massive turnaround specialists because we found a niche doing something completely different. So it's important to keep learning. And the way that you guys are growing through acquisitions is very interesting and very valid because a lot of the best, most successful CEOs over the last century have been people who have learned how to acquire very well. So they've allocated capital in a very intelligent way. So if you look at, I think there's a book called Outsiders by, I think it might be William Thorndike, and each chapter is on some of the best CEOs of, they tend to be American, but all of these guys they're not, the archetypal sort of Steve Jobses, who are these sort of amazing kind of magicians, but they are people, like Buffett, but in some other cases where you wouldn't have heard of, where they have actually given tremendous returns to their shareholders, better than a lot of the big names that you would associate, through allocating capital in very intelligent ways, and usually that comes through in the cases that in the book through intelligent acquisitions. So it's a very good way of running your accounting business, provided that you are intelligent about it and you don't overstretch yourself and take too much leverage and the usual things that can kill companies.
No, and it is hard to manage an acquisition and day to day. I mean, we kind of did it when we did our acquisition. What we technically did was we transitioned our consultancy base of clients because we grew that relatively quickly. I mean, we grew to about between 300,000 and 400,000 turnover in consultancy within the first couple of years. I did, but at the end of the day, to me, consultancy comes with high risk, so we wanted to stabilize a little bit. So what we typically did was we did the acquisition to sort of leverage a different type of client base so that we could stabilize the business model a bit. Because as the overheads increased with people, we needed more stabilization. So it's been a bit of a challenge, and also we care. I do think the accounting industry is quite poor in general for average business owners. Well, that was why I started the firm, and we want to offer a better service and give people more clarity and advice over their accounts, because in the end it's all that will build up behind the scenes to help them maximize their wealth on exit. And we are doing that. Lots of so I think probably when we first met you, Taha, we focused a lot more just on acquisitions, but now we've got a lot of evolving, I suppose, discussions going on where actually that's evolving not just to acquisitions, but actually to people thinking, how do I maximize my wealth and exit? And that would include, stabilizing and bringing in an infrastructure into their business.
Yeah, absolutely. I mean, I've had a very good experience working with your company on developing our, accounting metrics and framework and management reports. So yeah, it's a lot of value add you can get from a decent set of accountants for your profitability. So yeah, it's certainly is helpful.
Yeah, and just at the end, Taha, I mean, I'm just interested to know then, so obviously you went on this journey to diversify the portfolios. In terms of your group then and your over investment portfolio, I mean, has it done what you wanted to achieve at the beginning?
I think it has. I think there is a temptation to kind of go to the next one, but you've got to remember that, success, you've got to build success gradually over time. And the last thing you want is to have a deal that doesn't go well, because then, your reputation is at stake. So we're just balancing kind of wanting to go quickly and grow quickly, but with the need to ensure that the foundations are all in place with our two current deals. So, but yeah, they've done what they said they were going to do, is in our portfolio. And but they've also provided a huge amount of learning that we will hopefully leverage in our next transactions. Yeah, I mean, most importantly, we've really enjoyed it. So it's kind of, not only have we made some decent returns, but we've enjoyed working with the MDs and the families that we've from other companies that we've bought, and yeah, it's just all in all, happy days.
Oh,
Good
brilliant.
returns. Yeah.
Well, I just want to say it's coming to the end of the podcast now. So I just want to say, Taha, it's been so great hearing your story. Thanks for sharing it. If anybody's looking to reach out or sell, have you got any criteria? Are you looking at the minute, or any interested people you're interested in speaking to?
Yeah, I mean, if you ever want to get in touch with me, I've got my probably Twitter is probably the easiest place, at Tahar Afshar, or LinkedIn. You can just drop me a message, and I'd be happy to follow up on that. And yeah, I mean, if you're obviously interested of selling your business, happy to have a chat at the same time. But yeah, more than happy to help. But
All
thank you.
right, brilliant.
Yeah. Thank you very, very much for having me. It's been my first podcast. So let's see if it's one of many or the first and last. But yeah, I really appreciate it. Thank you.
No, and we found out, didn't we? It's episode 41, which and both of us are 41, so
there you go.
Very close together. So and I just want to say thanks to all the listeners. If you do like the episode, hit the subscribe button so more people can find the channel, and we'll see you again soon.